that could potentially mean. We're joined by Mike Rothman, founder of macro energy research firm Cornerstone Analytics. Thanks so much for joining us.
Thank you.
So that possibility there, Russia saying, we heard from the Russian central bank governor saying that for countries that are in on this potential price cap on Russian oil, Russia wouldn't supply oil to them. What kind of impact would that have?
Devastating. Russia is the second largest exporter of oil in the world after Saudi Arabia. And if you look at crude and products, it totals around 8 million barrels a day, which nobody can make up. Not OPEC, not all of the emergency stocks if they were released at the same time. So it would be a devastating impact to the market. And the market's already in a tightening trend.
And I wonder, Mike, the governor also said, the Bank of Canada governor, no, the governor of the Russian central bank also said that countries that were ready to cooperate with Russia they would be able to redirect the oil or other, energy products to them. Would that have an impact?
So what's getting a little bit lost is that you have the U.S. embargo already in place. That affects about 10% of Russian flows. And then, of course, the bigger beast afoot is the European embargo, which is supposed to have started getting phased in this month and be phased in by the end of the year. That's about 3.5 million barrels a day. So that's a much bigger chunk. That's about 40% of Russia's flows. And the issue Russia will have is not these various schemes about getting paid in rubles or some other manner to evade banking issues. It's whether Russia will be able to really place oil that should go to Europe into other countries. That's the big concern, and that's a concern everybody should have. The secondary issue, which doesn't seem to be getting too much airtime right now, is Russia's disruption potentially of natural gas. Now, they send out the equivalent of about 4 million barrels a day of natural gas. Most of that is to Europe, and the issues that are afoot and what's been affecting the market both ways in the last week is discussions about whether those exports are actually going to be disrupted. So for an oil market that's already tight, losing any supply is a problem. And we've already seen a reduction in Russian supplies. They have not been able to fully place all of their oil.
When it comes to the natural gas side of things, Mike, we saw the Nord Stream pipeline come back online at 40% capacity. That's what the data is showing so far. Even with that, what sort of an energy crisis is Russia facing at this point?
Well, the issue with Russia is not so much the crisis it faces, it's the rest of the world, the consumers, the importers. And the flows.
Sorry, did I say Russia? I meant to say Europe. What sort of an energy crisis does Europe face at this point? Sorry, Mike.
So the heating season is 4 months away. European inventories are low. There is a problem with natural gas, methane availability in general in Europe and in Asia. So the concern is Russia has a history of weaponizing its energy. They've effectively learned how to weaponize winter, but they've weaponized their petroleum and their natural gas supplies. And because of the pressure being brought to bear on them to basically leave Ukraine, they are in turn using their energy exports as a means of stiff-arming that opposition to their invasion. That's the rub. And as I said, when you look at the big picture, if you just step back and look at the global picture, you have an already tight global oil balance. We've had 750 million barrels of inventory removed since the summer of 20, and we're still losing inventory. So when you think about that big picture and the idea of now having supply hits that weren't really built into anybody's outlook, it creates the risk of a severely tight oil balance and significantly higher oil prices.
What is demand like for oil right now? Are we starting to see, we were looking at, gasoline stockpiles in the U.S. coming down, increasing. So I just wonder, what is the demand picture like at this moment?
So the U.S. Oil demand picture of late has been somewhat soft, and people have tried to extrapolate that this is going to be a headwind now for the oil market. But the thing is, if you look at global oil demand, it has come in higher than forecasts 6 quarters in a row. In fact, in the just ended quarter, global demand averaged about 1.3 million barrels a day above what the consensus was projecting. So we've had a string of numbers that show it to have been much more resilient than people in general were looking for. If you look at close to real-time indicators like air traffic, we just posted a 4-year high in global air traffic. So in terms of the work we're doing, what we see happening in, again, close to real-time data for things like inventories or other metrics, demand looks like it's on solid footing.
So even if that's global demand, so even if there is some demand destruction happening at a more, localized level to the U.S. or to Canada, I mean, it doesn't really change the picture much there.
Well, again, if you step back and look at the overall trend, the OECD countries, the U.S. and Canada are obviously two main countries, haven't been much of a contributor to global oil demand growth in 20 years. Almost 100% of all your oil demand growth since year 2000 has been in the emerging markets. So people look at the U.S. because the data is very easy to get a hold of. Even Canadian data is fairly easy to get a hold of. But what we care about when we think about the big picture is what is happening in those EM or non-OECD countries. And they are growing much quicker than people, I think, had generally anticipated.
So what is your expectation for the price of oil here, Mike? Because, I mean, we see it fluctuate actually quite significantly on an even day-to-day basis these days. I mean, it's trading around, I think, $96. I'm talking WTI. It's 94 now. So it's under the $95 a barrel level. What are you thinking in terms of that price?
Okay, so the recent pullback we've had over the last 6 weeks to us is just a pullback. And most of it reflects this concern about economic headwinds. So you have not seen a demand collapse, which many people have asserted. What you have seen is weakness in the financial demand for oil, which is a factor we do have to consider because the paper market for oil is about 50 times bigger than the actual oil market. If you look at the fundamentals and what we see happening with inventories likely to continue to draw larger than normal, outsized draws at the end of the year, OPEC capacity bumping up against its limits, we're very much on the side that oil prices are going to move substantially higher from these levels. So this pullback is an opportunity for investors to lever in or get back into energy equities or oil-related instruments that are leveraged to oil. But the trend is still very much in a bullish angle from our point of view.
How much is substantially higher?
Well, the numbers we've published and have talked about, including interviews I've done with your group before, is that if you think about the medium-term outlook, we think oil prices are going to have to get to levels that ultimately start to choke off demand. And when you think about that, you're talking about annual averages that go north of $130 a barrel. So still much more upside.